Buyers and sellers are in a showdown right now. Right now, we're seeing demand destruction take place as mortgage rates continue to soar and buyers get priced out of the housing market. And at the same time, we're seeing supply destruction take place as new supply that comes on the market is continuing to plummet. We're in a really interesting situation right now as the future of the housing market really depends on who's going to flinch first between buyers and sellers. You see, sellers on one hand are still living in the past. They think they can get top dollar like they were able to back in spring, and that is not the case anymore. And you have buyers who are just not interested in purchasing with these new higher mortgage rates, and many of them can't even afford it and don't even have the option to if they wanted to. So as a result, housing sales are down again as of the latest data that we got from the National Association of Realtors, and their latest report also showed how home prices came back worse than expected with unexpected declines. So lots to discuss in today's video, and as we know, the Federal Reserve did recently hike interest rates again for the 5th time this year. This was expected, although the gloomy projections they gave came back more aggressive than anticipated. And so there's a lot to discuss and go over as far as the details of that is concerned and how that will have an effect on the overall health of the housing market. But before we get started, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. Recently, we've been having this ongoing battle of supply and demand taking place. We've been seeing demand plummeting, we've been seeing supply plummeting, and so as a result, there's an interesting situation taking place right now. As far as demand is concerned, we've been seeing mortgage rates continue to get closer and closer to those 7% levels. We recently saw mortgage rates reach as high as 6.87%, which is the highest rates we've seen since 2008. Now, naturally, these higher mortgage rates are causing demand destruction to take place as many home buyers across the country are getting priced out of the housing market. Now in June, housing affordability levels came back at the lowest levels we've seen since 1989. And honestly, with the way the mortgage rates have gone up so significantly, I'm anticipating that September numbers are going to be even worse. Now we're seeing evidence of demand weakening across the country as the Mortgage Bankers Association, they've reported that although we're seeing a slight uptick in purchase applications week over week, year over year, we're seeing a 30% decline. Now, like we said, this has obviously been triggered by mortgage rates and housing affordability going down. But in addition to that, inflation has been really the biggest contributing factor recently to mortgage rates surging again. You see, the latest inflation data was released a couple weeks back, and we saw that inflation came back at 8.3% growth year over year and up 0.1% month over month. Now, these numbers came back worse than expected because we're already artificially bringing down gas prices by releasing 1 million barrels of gas per day from our strategic petroleum reserves. So understanding that gas plays a huge role in our economy, you have to understand that if you have gas prices going down over 10.6% month over month, and then the month before that, gas prices going down over 7%, so we have gas prices plummeting, and yet even with that taking place, overall inflation is still going up. Now these numbers freaked out investors because investors realized that the Federal Reserve's number one priority right now is tackling inflation. And so as long as inflation is a problem, the Federal Reserve is going to stay aggressive, perhaps even get more aggressive, and perhaps even for a longer period of time than initially anticipated. So naturally, we saw demand destruction with Treasury bonds in anticipation of the Fed meeting. And between that and what was actually said and the projections that were given, we saw the 10-year Treasury bond yields jump to over 3.7%. And in the last 24 hours, we've seen it hit as high as 3.9%. Now, the reason we care about that is mortgage rates typically follow the trends of the 10-year Treasury, and so that's why we've been seeing mortgage rates climb so much recently. You can actually see it right here on the chart, and the day they announced inflation on the 13th, you saw mortgage rates start to spike up again. Now, during those meetings, we know the Federal Reserve ended up deciding to hike interest rates again another 0.75%, but that was not the real story of the day. The real story was about the summary of economic projections projections, and the dot plot. Now, for those who don't know what the dot plot is, it's basically a visual representation of where each Federal Reserve member thinks the interest rates are going to be headed towards. They basically put their dot on a chart as far as where they think they'll land. So you can see here on the dot plot that by the end of the year 2022, about half the Federal Reserve members expect interest rates to go up to 4 to 4.25, and the other half are expecting between 4.25 to 4.5. You can also see that in 2023, they're split up into about 3 different groups as far as where they project the interest rates will land, some of them projecting that they'll land as high as 5%. Now, to put it in perspective, keep in mind the current Fed funds rate, even with the recent rate hike, is sitting around 3 to 3.25. Now, although it's interesting to hear about their expectations for the future, you kind of have to take it with a grain of salt, because if you just go back to last June's meeting, they were expecting rates to be at around 3.25 to 3.5 by the end of the year, and we're already pretty much there right now. And if you go to last June's meeting in 2021, they were expecting interest rates at the end of 2022 to land at 0.5%, which is way off base of where we're at now, and that was back when they were still in denial of inflation being a problem, inflation was transitory, all of that. So I guess the point I'm trying to make is whatever they're saying out loud, you have to anticipate it's probably going to be worse than what they're publicizing. You can also see that they project things like the unemployment rate, which they're expecting to see 3.8% by the end of the year. We're currently at 3.7% right now, so I do think we'll end up a little bit higher than that. They're also anticipating unemployment to go up to 4.4% for the year 2023 and 2024, slightly going down to 4.3% for 2025. You can also see that they're expecting GDP to go up 0.2% by the end of 2022, 1.2% 2023, and 1.7% 2024. So overall, I really think these are very conservative estimates. I think we're going to see a higher unemployment rate than what they're saying. I think GDP is going to be worse than what they're projecting. I think they're kind of giving a very optimistic picture, although this is worse than they've given in previous estimates. Now, going back to this whole supply and demand dynamic, on the supply side, we are seeing new listings fall over 20% year over year, which is drastically having an effect on the amount of supply that hits the housing market. What we're seeing take place right now is sellers feel like now is not a great time to be selling their house, and the reality is there's not really a lot of incentive for them to sell their house. For starters, sellers know that the current market is geared more towards buyers than sellers, and so they feel they may as well wait it out until the market turns more in their favor, and so some are even choosing to pull their home off the market and rent it out instead until the market turns more in their favor. Secondly, Redfin recently reported that over 85% of all homeowners with mortgages are under a 5% interest rate. This is a big deal, and it's even worse in some areas where you see Utah is at 93%, Colorado and Idaho are at 91% of homeowners. So when you have this going on, who's going to want to give up a 3 or 4% interest rate for something like a 7% interest rate? And that kind of brings us to the third reason why they wouldn't want to sell their house right now, is that they have to find another place to live. Realtor.com reported that you would pay 2/3 more per month for the same house you would have done a year ago, and that's largely due to home prices going up combined with mortgage rates surging. So when you have these new listings declining like they are, and you have home buyers bowing out because they simply can't afford to buy a house based on the house prices and mortgage rates where they're at right now, you're starting to see existing home sales decline as well, like they've been recently reported by the National Association of Realtors. August numbers recently came back showing that existing home sales are currently down about 20% year over year and down another 0.4% from month over month. Now, these are nationwide numbers, and this is really the slowest pace we've seen of home sales since November 2015, not counting a quick drop we saw in the pandemic. Now, some cities are standing out even more than that. We saw that Phoenix saw the third largest drop in home sales year over year with a 31.9% drop. We also saw San Jose, California come in at number 2 with a 33.8% drop year over year. And Las Vegas, Nevada saw the biggest drop in existing home sales, a drop of over 37.2%. Now, this nationwide drop in transactions has largely been attributed to the monetary policy of the Federal Reserve. And with that said, had we not seen such a steep decline in new listings coming on the market, we'd probably be already seeing steeper declines in home prices at this point. Regardless, the numbers for a drop in home prices actually came back worse than expected, as we saw the National Association of Realtors reported that for August, home prices dropped a total of 5.9%. Now, typically between June and August, you might see maybe a 2% blip for seasonality seasonality, but in this case it came back even worse than expected, and we saw a drop go from $413,800 for the median sales price now down to $389. So this is a very strong signal that this is not simply seasonality taking place with these price declines. This is a bigger housing correction that's actually happening right now. Now looking ahead, I'm not expecting the September numbers are going to look that bad for home prices, because really you're talking about homes that closed in July and August when interest rates really saw that dip down to the 5% level. October though is a whole different story, and that's going to be our first little bit of insight into how people are handling these higher mortgage rates, because we're going to see homes that went under contract end of August, maybe beginning of September, even mid-September, and so that can give us a good idea as far as what the next few months are going to look like. So overall, I'm interested to see who's going to blink first between buyers and sellers. The reality is that sellers have reasons not to sell and buyers have reasons not to buy, but at the end of the day, our current reality is that this is just simply where interest rates are at, and there's no guarantee they're going to go back down again to those 3%, 4% levels anytime soon. What I do think is likely to happen is the Fed is definitely going to stay aggressive at that point. They've reiterated that point over and over again, and they're showing it and backing it up with action to this point. I think 7% interest rates are inevitable at this point, and we may even be talking about is 8% in the cards. In addition to that, demand destruction is going to happen, because if you can't qualify, then there's nothing you can really do about it. You're just simply out of the housing market as a buyer. The question is, will sellers eventually accept this new reality and be willing to trade in their locked-in 30-year fixed rate at a very low 3 or 4% for that higher 7% interest rate for the sake of upgrading or getting a house they want? These are the things I'm going to be looking for, and I'm going to be keeping you guys up to date with what's going on in the housing market. And if you enjoyed today's video and you gained some value from it, do me a favor and smash that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, let me know your thoughts or questions in the comments below, and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out of State Investor. And if you enjoyed today's video, I'm going to highly recommend checking out one of these two videos over here. And with that said, I'll see you guys on the next one.